Thank you so much for taking out time for us. Let's get going to our next guest. He's a market guest. He's now joining us live. So thank you so much for taking out time for us. Could you just start by what's really happening in the market? Uh, when we look at the markets versus the rest of the world, what is the sense that you get?
Sure. So, post Jackson or post the strong rally we saw in between June and August, there were two outcomes, right? That either Fed learned to live with 4% or they sort of stamp out inflation. Clearly, they have taken the second trajectory. Now, last week there was some confusion when BOE came in to calm the markets, and some people thought that central banks are not pivoting and that Fed would eventually follow. That's not the way we read it. Defined benefit pension, they need to have fixed payouts. And it's a bit technical, but what essentially happened is that the security that they're given to banks as collateral was marked down. So there is no pivot happening as such. And also over the weekend, we saw news on Credit Suisse and Deutsche, and both have opened down around 10% and 3-4%. So clearly a lot of news flow going around, and specifically to India, if Fed doesn't pivot, India has already lost 90 billion in reserves. So RBI will be sort of forced to keep raising rates to prevent currency, and even when the economy isn't heating up. So this will all come with its own set of challenges. Lower crude is great, fertilizers price also continue to be higher. India is in a good spot.
Right. So, which are the sectors that you would essentially want to pick up? Would you go with banking name? Numbers are coming in pretty strong. Would you go with consumption name or inflation can hurt them? Which are the sectors or themes that you would play in this market?
Sure. So the themes or sectors they need to be domestic facing, right? As you said, it has to banking or microfinance also. They are recovering from a bad sort of 2 years. Cement and even staples are doing well now. So the themes to be associated with clearly are domestic facing. Even for financials, you just look at the provisional numbers we got over the weekend. Someone like a Federal Bank, etc. They all reported very good numbers. So although system level liquidity is running a bit tight, but we shouldn't be too worried about it. It's a seasonal effect. So financials should report very good numbers, and H2 should be better. The other sector we like clearly is staples too now. So in staples, what's happening is rural is not doing too well, but urban is doing very, very well. So companies like Hindustan Lever should report very good volume growth, and the margin pressure that we saw during Q1 should ebb. We should get to close to normal margins in Q2, and definitely a very good trajectory even in margin for Q3. And talking of consumption, we also like the retail space. So something like Aditya Birla Fashion or that whole apparel retail space should do well. They again they have a bad days, but on that bad days, we hear very good numbers coming through, and the festive season should also be good for them. So everything that's domestic facing is good, like except for cap goods. Cap goods have done very well for now. Sector should do well, but the valuations have sort of run up much ahead. So this sort of sums up the view on where we are positive on.
Right. So, in terms of auto volumes, how would you essentially look at that? Do you think auto volumes are pointing out towards a better recovery?
So auto volumes are the mixed bag. I mean, of course they are best ever, but the issue is that it is a lot of backlog that is flown through. Right, the semiconductor issue has ebbed not fully, but for a lot of models it has. So a lot of order backlog is getting serviced. We'll probably get to know better around November or December numbers when we actually know the true picture of auto volumes. Secondly, also the sector was inexpensive, let's say a year back. It was in the value zone. The sector has sort of run up. They've covered a lot of valuation differential with the market. So that safety, margin of safety is no longer there in auto. And lastly, in two-wheelers, we are seeing disruption from EV. So whenever a sector gets disrupted, we generally see the valuations remain low for a long period of time. So especially on two-wheeler side, we would be careful. The CV and MHCV space, they're coming off 4 or 5 years of sort of slow growth. There is a lot of pent-up demand there. So CV space is what we would prefer within auto at this point of time.
Right. In terms of financials, how would you approach this market? So, one is the private banks which are declaring numbers doing well. How would you look at the leverage plays? The likes of, say, AMC business, insurance business, what's happening with a lot of large NBFCs. How would you look at these businesses?
So within financials, let's take segment by segment. So the largest sort of segment outside banks is insurance. So within insurance, we prefer life over non-life business. Non-life business is sort of getting disrupted. There is a lot more competition in the non-life business. So that we would sort of wait for to look at it. Within the life insurance business, the a 15% sort of growth over medium term is still given. India remains an underinsured market, so gradually even the product that the insurance companies are selling is moving away from ULIP or savings product more towards protection. It's gradual, but it's happening. And what this has resulted in is the margins of the insurance companies going up. So that's why life insurance. Within life insurance, I think SBI Life has a lot of runway. They still don't sell through all the branches. So SBI Life has a lot of runway, and in terms of valuation, Max is corrected a lot. So these two look interesting within the insurance space. Within the AMC business, competition continues to be high, and the sort of retention that most AMCs are getting continues to sort of reduce. Also, passives are taking away market share from active. So AMC business is while the growth continues to be very good, unlikely that the profitability growth will sort of shadow or mirror the growth in the top line. So AMC business we don't like as much. NBFCs again a mixed bag. Within NBFCs, gold finances continue to be under pressure. We've seen issues with vehicle finances. Within NBFCs, the most preferred place to us is MFI. A lot of cleanup has happened, and now the collection efficiency for most people is close to 100%. So we should see some unwind also of the earlier provision in MFIs.
Right. So just the last word on FI versus DII. FIs have been selling, DIs have been net buyers. Do you expect this structural shift to continue for now?
So within DIs, right, a lot of domestic money which used to go to gold and real estate or even bank fixed deposits is now moving toward the market either through alternative asset managers like us or through agencies or even direct, right? Every month we see those 20 or like 30 or like accounts open, which generally means 6,000 crores is coming directly into the market, plus insurance, plus alternatives. So this shift is structural. We've still covered only a fraction of the population, right? 10, 12 crore demat accounts, but there are multiples to that. Even in mutual fund, the unique PAN cards are less than the 4 crores. So a lot of runway to go within domestic. So yes, we expect the shift to continue. Domestic should become increasingly bigger portion of the market.
All right, sir. Thank you so much, sir, for taking out time for us. Good to get perspective. On that note, we're taking a break. Stay tuned. Lots more lined up on the other side.